As we move ahead in our discussion on financial management, we now move towards the core financial theory that underlines almost the entire finance studies that we do at this point of time. This is an area where we're going to start our discussions on topics such as risk, return, portfolio theory, and everything that comes under that. So portfolio theory and things like diversification, etc. How do we optimize our returns from the perspective of finance? How do we create a portfolio? What is the theory of markets at this point of time? That's all that is going to form the crux of our discussion from now on. This will build on some of the stuff that we have already learned, which is what are the various asset classes. We have read a little bit about asset classes such as equity and debt. We have seen how do we value these asset classes. We have learned a little bit about derivatives and how can they be used in the context of financial management. We will look at the understanding, at least broadly, of a few other asset classes and what kind of historical precedents have they had in terms of risks, in terms of returns globally. And we'll talk within that about some of the asset classes such as real estate, and also on stuff like commodities as we go along. But at this point of time, we will focus more on the first premise, which is risk and return. So the first set of videos that will come under this will try and make better our understanding on what is the risk that we look at when we look at in the financial context. How do we measure that risk, and how do we measure the expected return on a particular asset class, right? So that's going to be our primary discussion points, our introduction to risk and return. The topics that we'll cover over the course of the next few videos are outlined here. They may not be in the same order, but this is what we'll try and cover in the first set of videos that will come to you. So let's begin with a basic understanding of risk and return and ask ourselves a few questions, right? The first question we would like to ask ourselves is that given a choice in these two images that you see, if someone were to ask you that you have to invest money in either stock market or what we know as equities versus bonds, commonly referred to as, or one of the bonds is, one of the way we look at bonds is a fixed deposit in a bank, so a bank FD. So if someone were to give you a choice that you have to invest in equities or a bank FD, what would you choose? Right? Now, depending on how we look at or where our outcome is, we do know that the stock market, which is commonly known as the Wall Street in the US, and what we see here is a news piece from 1929, right? So 1929, there was a great crash in the US market. There was a depression that followed in the economy, and that's known as the Great Depression. This lasted for about 20-25 years. So around that, there was a news item that came, which is represented in this image, basically outlining the fact that equities are volatile, and there could be a scenario where you could lose all your money in the case of stock markets, right? So if the stock market crashes, you could lose your money. With bank fixed deposits, that's not really the case. If you invest 100, you're going to get your 100 back, right? So there is some sort of what we say capital protection when you look at bank fixed deposit. Now, depending on what your idea of money management is, depending on what you want to do with that money, assuming that you don't want to gamble with that money, you want to get some sort of sensible returns with the money, almost everyone would start looking at these two pictures, start moving towards the fixed deposit, right? Now, why did we choose fixed deposit? One part of it was saying that there is a capital protection. The other part was that there is some sort of an uncertainty with stock returns. They tend to become volatile. And the third part would possibly be, when do I get my money back as well, right? So what are the key decision points? Why do we choose a fixed deposit? The first part is we get decent returns out of it. So we get some sort of sensible returns out of it. If I invest 100 and I make 106, that's a 6% return, right? That's not very high, but that's a decent return to kind of get a sense of where we are, right? It's secure, which basically says that there is safety of capital that I have invested. I have earned this money the hard way. I don't want to lose it, kind of a thing. And the third part is there is no uncertainty with respect to time. So there is a fixed time horizon when I will get my money back. There's a fixed time horizon when I will get my money back, right? So that's the basic reason why most people who would choose a fixed deposit in this context would go towards choosing a fixed deposit. That's primarily the reason why a fixed deposit is supposed to be chosen in this case, right? So we're trying to build on a case one by one in terms of what are the important objectives that one looks at while choosing a certain investment alternative or avenue, right? So people look at returns, people look at safety, people look at what is the time horizon, right? Let's build a little bit more on this, right? Let's take another case. Now, let's say product A, there's a product in the financial markets, which could be equities, which could be bonds, which could be a mutual fund, any product in the financial markets gives a 40% return. What does it mean? It means that rupees 10,000 invested this year will become or will give you rupees 14,000 next year, right? So that's a 40% return that you're getting here. Product B, which is another product, on the other hand, gives you only a 20% return the next year, right? Now, in the absence of anything else, it seems very clear which one will you choose. So if I were to put a question to you, which one would you choose? I'm reasonably certain everyone would choose product A in this case, right? But there must be a catch because this can't be so easily and simply possible, right? So let's see if the decision making changes based on a little bit of change in scenario, right? So what do we introduce? Product A gives 40% return, which means 10,000 invested will become rupees 14,000 next year. But there is a condition that there is a probability of losing money. There is a possibility that you could lose money as well. It expects to give 40% return, but there is a chance that you could lose money, and that chance is 80% here. Product B, on the other hand, expects to give you 20%, but there is a chance that you could lose money, and that chance is 20%, right? In our first example, if you remember, there is a chance you can lose money here. There is some sort of a chance you can lose money here. Here, that chance is 0%. Now we are quantifying the numbers. We are saying that in the first example, there is an 80% chance you could lose money. In the second example, there is a 20% chance you could lose money. So where are the chances that you lose money higher? Those chances are here. Now the decision making becomes not so clear. Some of us may still say that we would want to go for 40% return with a chance of losing money that is 80%. Some of us may choose that we may want to go for 20% return. That's fine, we get a lesser return, but the chances of our losing money is also lesser, right? So if I put in 10,000, I will get 12,000, which is lesser, but I will not get less than 10,000. So what does this mean? If I invest 100 times, if I invest 100 times, or if I invest 10 times, then 8 times I will get more than 10,000. 2 times I will get less than 10,000. Whereas in this particular case, if I invest 10 times, 8 times I'll get less than 10,000. 2 times I'm going to get more than 10,000. That more than 10,000 could be 40,000 or 14,000 or whatever. But 8 times I'm going to get less than 10,000. Now, some of us may want to risk this for an expectation of a 40% return. Some of us may not want to do that. So now the decision making changes. It is not so clear. It was very clear here that everyone would have chosen product A. But the moment you introduce the concept of uncertainty, that there is a chance of you losing money on it, the decision making is not so clear anymore, right? So what do we do? What affects our decision? What affects our decision is the uncertainty that is around the returns. Remember, we've already seen that in debt instruments or in bonds, there is limited uncertainty, right? Or there is less uncertainty. If you hold it to maturity, you will make money. But in stocks or equities, there is a high amount of uncertainty because it depends on how the underlying company will perform, right? So as uncertainty increases, your chances of losing money also increase. As those chances increase, there is a possibility that it starts affecting your decision making on what instrument do you choose. Now, at this point of time, we have just taken an assumption that uncertainty is defined to us. At some point of time, we will have to calculate it as well. Right, so we will bring that into our discussion at a relevant point as we go along. But at this point of time, we do understand that uncertainty is going to impact our decision making, right? Let's look at another case. Now, product A claims that it may give 40% return and it gives this next year. Product B claims that it may give annualized 40% return but gives this after 5 years, right? Now, if you look at these two and they are almost the same in terms of what return do they generate, right? 40% here and annualized 40% here. But the decision point is in terms of what is the time, right? So the decision point here is in terms of time horizon. Also, when do you want the money and how much money do you want to have at any point of time? Let's say I want to pay for something next year. Then not only time, but also the fact that I need liquidity. What do we mean by liquidity? The ability to use money at any given point of time is known as liquidity. So maybe if I need money next year, then that starts impacting my decision. The longer I give money for, the more the chances are that someone might run away with the money or the more the risk around that product. Remember, we've already seen that in the case of bonds, if you're looking at a 1 year bond versus a 10-year bond, where is risk higher? The risk increases this way. Why? Is because you're giving your money out for a longer tenure. You're risking liquidity at this point. You're risking the chance of you having money at this point at the expense of giving out, getting a return at a later stage. What are the decision points in this case? The factors that affect your decision at this point are going to be the time horizon and the liquidity. When do you need the money and how much money do you want to have in your hands at any given point of time? So that's where time and liquidity become extremely important characteristics that start affecting your decision. In general, you would want your money back earlier, all other things being equal, and you'd want a higher amount coming back earlier. So in present value terms, the money is more important to you, right? So that's why time starts affecting your decision making as well. And there is a risk element that comes because of time and liquidity risk as well. Let's say you buy a stock, right? So if you were to buy a stock in a company like Reliance Industries, if something goes wrong and you don't like your decision, you can buy today and you can sell it tomorrow, right? There is no problem in this decision because the stock gets traded on stock markets. You can buy the stock today and you can sell it tomorrow. But let's say you buy the stock of some private company, right? Some unlisted company. For example, a company like Flipkart at this point of time does not trade on stock exchanges. It is unlisted, what is called as unlisted because it is not trading on stock exchanges. You can buy a stock in it today as well. You can go and buy the ownership of Flipkart today. A lot of private equity funds do that. but you cannot sell tomorrow, or you cannot sell it tomorrow easily. That will become difficult. Why? Is because you need a buyer to buy it from you, and there is no market or exchange that allows you to do that. That is where the role of the exchange becomes extremely important. Correct? So that's the important part around having an exchange or a market-driven scenario where liquidity becomes an important, and there's a risk element that is going to come because of liquidity as well. So what are the broad decision points? We want higher returns, as high as possible. We want to generate excess return as well. Higher is fine, but we want to get excess return over and above a base return, right? So for example, if inflation is 8%, I want a return more than 8%, right? Higher here is a relative term. We don't know what is high. 7% might be high for you, may not be high for me. When we say excess return, we do need more than 8% if inflation is 8%, right? And we want higher excess return when compared to other assets. So if there are three assets and they are all generating excess return over and above inflation, you would want the one which gives you the highest return, right? Maybe you would want to get the returns fastest as well, as soon as possible, correct? And you want to do this with the least amount of uncertainty. You don't want probabilities to come in the way of your making money. You want to buy the less risky asset, whichever inherently has a less risk. Like if you're told that stocks will give you 10% return and you're told that a bank FD will give you 10% return, then there's no reason to buy stocks. You have to buy a bank FD because it's secure, it's going to save your money, it will be safeguarding your capital. And you want to use as less a time period to get your money. So you want to get the money fastest, right? That's what we discussed here. You want highest return, fastest possible, with the least risky asset and the least amount of uncertainty. That is the ideal situation that every one of us would want to be when we are looking at something like a decision point in terms of risk and return, right? Having said that, it's obvious that if risks are higher, people will start expecting higher returns, right? We have discussed this in the past that as risks of bonds increases, your expectation of returns on those increases. Similarly, as risk of stocks increases, the expectation of returns on those will increase as well, right? So that's the broad premise now, right? Now, how do we calculate return? We've seen this earlier as well in terms of calculation of returns on bonds and returns on stocks. You get the price now, you get the price when purchased, and you divide it by the price when purchased. And if there are any cash flows in between, you use those as well, right? For example, if you purchased a stock at 100, the current price is 110, then your return is 110 minus 100 by 10, that's 10%. And if the stock has given any dividend, let's say it gave a dividend of 5 rupees, then your total return is going to be 115 minus 100 by 100, that's going to be 15%. So any coupon payment, any dividend payment, that's your cash flow that comes in between. Price now minus price when purchased divided by price when purchased. Straightforward. We've discussed this in the past, right? Now let's complicate it a little bit. Let's say there is an expected possibility of you getting a return and another possibility of getting another return. So we introduce what is called as uncertainty or probabilities into the event, right? How do we calculate expected return? So if there is a 50% chance of 10% returns, which means if you invest 10 times, then out of 10, 5 times you will get 10%. And there's a 50% chance of 20% return, which means 5 times you will get 20% returns. What is your average going to be, right? So what do? You basically just multiply the probabilities. You can calculate 5 into 10% plus 5 into 20%, which is going to be, this is going to be 50%, this is going to be 100%, add it up 150% and divide it by the number of occurrences, which is 10. So on average, you make a return of 15%. Alternatively, what you could do is the probability of 10% return multiplied by 10% return, or half the times you make 20% return. You make this calculation, you will again get 15% as the answer, right? Now, so your expected return is going to be somewhere in the middle, which is half of 10% and half of 20%, right? If we generalize this formula, you're saying probability of outcome 1 into the actual outcome 1, probability of outcome 2 into outcome 2. If you have more outcomes, then you keep adding. You say probability of outcome 3 into outcome 3 and outcome 4, and so on and so forth. You can keep adding these numbers as you go along. That's your generalized formula, right? Where does it come from? Straight mathematics. If you take 10, 5 times you're going to make 10% return, 5 times you're going to make 20% return, right? This is a simple example. Let's complicate the example a little bit. Now, if you assume that there's a 60% chance of 20% return, right? If you're doing things, investing in this asset 10 times, 6 times you're going to make 20%, and there's a 40% chance that you're going to make 10% return, right? What do? So, two ways you can solve it: 60% into 20%. That's what we just saw. That's going to be 12%. And 40% into 10%, that's going to be 4%. The expected return is the summation of these two, that is 16%, right? So that's how you calculate this return. In other words, out of 10 times you get 6 times you get a return of 20%, so that's a total return of 120%. 4 times you get a return of 10%, that's 40%. Total return 160%. 10 times 160% divided by 10 is going to give you 16%. That's what we calculated here, right? So once you introduce the concept of chance and probability, expected return becomes probability of event A1 into A1 plus probability of event B1 into B1, and so on and so forth. You just keep adding the probabilities multiplied by the actual outcome, right? That's what gives you a sense of what is the return going to be, expected return going to be. Now, why is this important? Is because when you're investing in an instrument, there is always an uncertainty. Other than fixed deposits, almost every other instrument will give you a range of possible outcomes, right? In real world, the range of possible outcomes could be infinite. Let's start with a simplified question around it, right? Let's assume there is an asset X which we purchase at 100, and there is another asset Y which we also purchase at 100, right? Those are the two assets. We purchase them at 100. Now, there are three possibilities. In the worst case, you will make 10% return. In an ideal case, you will make 15% return. And in the best case, you will make 7%, 17% return, right? Whereas for asset Y, in the worst case, you will make 7% only, lesser than the 10%. Ideal case is going to be the same. Best case is going to be much higher. That's going to be 20%, right? So in the worst case, you make 3% lesser. In the best case, you make 3% more as compared to asset X, right? What are the chances of these? So the worst case probability in both the cases is 20%. Best case is 60%. Ideal case is 60, sorry, and best case is 20%. What do? Can I calculate the return? I need to multiply 20% into this, 60% into this, 20% into this, and if I add this up, if I do a sigma of these three, I will get a return of 14.4% here. That's my return that we expect. That's going to be 14.4%, right? I can go to an Excel file and use a function called sum product for it. Remember, we've learned sum product. We take the product of these and then add it up, right? You do the same here. You multiply this with 20%, multiply this with 60%, and again this with 20. And what you get if you do a sum product is going to be 14.4%, right? So that's your returns in both the cases, and you find that the returns are the same. So how do you decide? How do you decide on this? So in case you have same returns in both the cases, let's look at the variability or variation. From the worst case to the best case, in asset X, you're going to make, there's a difference of only 7%. Whereas in asset Y, from the worst case to the best case, the difference is actually 13%, right? 7 to 20. Now, that's a big difference when compared. The difference is almost twice. The range of possible outcomes is almost twice of asset X in the case of asset Y. Now, assuming that your expected return in both the cases is the same, which is 14.4%, which one would you choose, right? Which means my chances of making returns, while I know that in some cases I might end up making 20 here, there are going to be some cases when I'm going to make 7. If I do both of these for 100 times, 20 times I'll make 7, 20 times I'll make 20. Right? So sometimes I'll make higher returns, sometimes I'll make lower returns, but over 100 times I'm going to make the same return in both the cases. So which one would you choose? Depending on again your expectation or definition of risk, you're going to define this, and all things being equal, you would want less variation to be the idealistic scenario, right? So once again, we go back to our decision points. What are our key decision points? Return should be higher, excess return should be higher, higher excess return than other assets, but I want less uncertainty. And when I say less uncertainty, this also means possible range of values, possible range of values that we find here, right? So that less uncertainty is going to define what is going to be my return expectation, right? So broadly speaking, what we have identified so far, that risk will go hand in hand with returns, and I want as less uncertainty as possible, as less risk as possible, and as earlier I can get my money as possible. That's going to be the best possible outcome for me. That's the broad first understanding that we have. I don't want a big range of outcomes, all other things being equal, right? Now, remember, that's a subjective analysis. Sometimes people might say they want a big range of outcome. It depends completely on what your choice or requirement is, right? So that's the broad definition on what's risk and what's return, what's uncertainty. In subsequent videos, we're going to kind of try and quantify this concept of risk as we go along.